Something significant is happening across the United Kingdom right now, and if you are a pensioner, or if you are supporting someone who is, this is not a video you can afford to scroll past. Between May and June 2026, a series of rule changes are rolling out that will directly affect how millions of older residents across Britain receive their payments, access their benefits, and manage their finances day to day. These are not minor adjustments. Some of these changes affect state pension amounts, eligibility thresholds, and the way certain support systems are calculated, and many pensioners simply are not being told about them clearly enough. Whether you are receiving the full new state pension, the basic pension, pension credit, or any combination of additional support, at least one of these changes is likely to apply to your situation. And here is the important part. Some of these updates come with deadlines, meaning that if you do not act or stay informed in time, you could miss out on money that is rightfully yours. In this video, we are going to walk you through every key change, what it means for your income, and exactly what steps, if any, you may need to take. We want you to feel informed and confident, not overwhelmed. So stay with us right to the end, because every detail matters here. And if you find this information helpful, please take a moment to give this video a like. It helps us reach more pensioners who need to hear this. Let us start from the beginning, because to truly understand what is changing and why it matters, we need to set the scene properly. The United Kingdom's pension and benefit system is one of the most comprehensive in the world, but it is also one of the most complex. It has been built up over decades, layer by layer, with different rules applying to different groups depending on when they were born, how long they have worked, and what contributions they have made throughout their lives. And every so often, the government reviews that system and makes updates, some of them small, some of them significant. What is happening between May and June 2026 falls firmly into the significant category. The first thing you need to understand is that these changes are not random. They are the result of ongoing policy commitments, annual review cycles, and in some cases, responses to the rising cost of living that has affected households across Britain over the past several years. The government's approach to pensioner support has been shaped in large part by something called the triple lock, a mechanism that was introduced to ensure that the state pension rises each year in line with whichever is highest out of three measures: average earnings growth, inflation as measured by the Consumer Prices Index, or a minimum of 2.5%. This commitment has been central to pension policy for over a decade, and it continues to play a role in what pensioners are receiving right now. For the 2026 tax year, which began in April, the full new state pension rose to approximately £221.20 per week. That is an increase that came into effect for those who reach state pension age on or after April 2016 and who have built up the required 35 qualifying years of national insurance contributions. For those on the older basic state pension, people who reached pension age before April 2016, the weekly rate also increased, rising to around £169.50. These are not figures to overlook. On an annual basis, the increases add up to hundreds of pounds. And for pensioners living on fixed incomes, that additional money can make a genuine difference to everyday life. However, and this is where many viewers may need to pay close attention, receiving the full state pension is not something that happens automatically for everyone. Your actual entitlement depends entirely on your national insurance record. If you have gaps in your record, years when you were not working, not paying contributions, and not receiving credits, your weekly amount will be lower than the full rate. The Department for Work and Pensions, commonly known as the DWP, calculates your entitlement based on the number of qualifying years you have accumulated. You need at least 10 qualifying years to receive any state pension at all, and 35 qualifying years to receive the full amount. If you are somewhere in between, your pension will be paid at a proportionate rate. Now, here is something that many pensioners either do not know or have not acted on yet. There has been an ongoing opportunity to fill gaps in your national insurance record by making voluntary contributions. This has been particularly relevant for people who took time out of the workforce to raise children, care for relatives, or who worked in jobs where contributions were not made correctly. The government extended the deadline for making these voluntary top-up payments, but that window is now closing. If you have not already checked your national insurance record, this is one of the most important things you can do right now. You can do this through the government's personal tax account at gov.uk. and it will show you clearly how many qualifying years you have, whether there are gaps, and what those gaps might be costing you in pension income over the long term. Moving on to another area of significant change, pension credit. This is one of the most underclaimed benefits in the entire UK welfare system, and it continues to be a serious concern for charities, advice organizations, and the government itself. Pension credit is a means-tested top-up benefit for people who have reached the qualifying age and whose income falls below a certain threshold. For a single person, the standard guarantee credit tops up weekly income to approximately £218.15. For couples, that figure rises to around £332.95 per week. These are the figures in play for the current period, and they represent a meaningful safety net for those who qualify. What makes pension credit especially important is not just the payment itself. Claiming pension credit also acts as a gateway to a range of other entitlements. People who receive pension credit may also be eligible for help with housing costs, council tax reductions, a free TV license for those aged 75 and over, cold weather payments, and help with NHS dental and sight test costs. This is why the underclaiming of pension credit is such a significant issue. Hundreds of thousands of older people across Britain are believed to be missing out on money they are fully entitled to, simply because they assume they would not qualify, or because the application process feels daunting. The process for claiming pension credit has been simplified in recent years. You can apply online through gov.uk, by phone through the Pension Credit Claim Line, or by post. The DWP has made clear that it wants more eligible pensioners to come forward and claim, and there have been active campaigns to raise awareness. If you are unsure whether you qualify, the best advice is simply to check. Even if your income is slightly above what you think the threshold might be, you may still be eligible if you have certain housing costs, disabilities, or caring responsibilities that are taken into account in the calculation. Let us now turn to the issue of council tax, because this is an area where rule changes at the local level interact with national pension policy in ways that can significantly affect pensioners' outgoings. Council tax support, sometimes called council tax reduction, is administered by local authorities, which means the rules can vary depending on where you live in England, Scotland, or Wales. However, many councils have been updating their schemes and in some cases tightening the criteria or changing the maximum discount available. If you have not reviewed your council tax support entitlement recently, now is the time to do so. Some older rules that protected pensioners from significant council tax bills have been adjusted in certain areas, and it is important to know exactly where you stand in your local authority area. In Scotland, the rules around council tax and pensioner support are administered differently under the Scottish Government's framework, and there are some specific protections in place. In Wales, similar principles apply, but again with local variation. The key message here is that because this is a devolved area of policy, what applies to a pensioner in Manchester may be different from what applies to someone in Cardiff or Edinburgh. If you have not had a recent conversation with your local council about what support you are entitled to, a simple phone call or visit to your council's website can clarify your position. Another update that has been generating considerable discussion among pensioners relates to the way that benefits and pension income interact with the tax system. The state pension itself is a taxable income, which surprises some people who assume it is paid free of tax in all circumstances. If your total income, including your state pension and any private or occupational pensions, exceeds the personal allowance, which currently stands at £12,570 per year, you will be liable to pay income tax on the amount above that threshold. As the state pension has increased year on year, more pensioners are finding themselves either crossing that threshold for the first time or moving into a position where their total tax liability is increasing. His Majesty's Revenue and Customs, known as HMRC, manages the collection of this tax, typically through the pay system or through self-assessment. If you are in any doubt about whether you are paying the right amount of tax on your pension income, it is worth contacting HMRC directly or seeking guidance from an independent financial advisor. HMRC also operates a tax checker tool on gov.uk, which can give you a clearer picture of your situation. The important thing to understand is that paying too little tax now can result in a demand for underpaid tax later, which can come as an unwelcome and stressful surprise for pensioners on fixed incomes. Let us also talk about what is happening with winter fuel payments, because this has been one of the most widely discussed changes affecting pensioners in recent months. For many years, Winter fuel payments were paid universally to everyone over a certain age, regardless of income. That policy changed, and the payment is now means tested, meaning it is linked to whether you are receiving pension credit or certain other qualifying benefits. This shift caused significant concern among pensioners who had previously relied on this payment, worth up to £300 per year, to help with heating bills during the colder months. If you are currently receiving pension credit, you should be receiving the winter fuel payment automatically. If you believe you are eligible for pension credit but have not yet claimed it, this is another compelling reason to make that application as soon as possible. The DWP has guidance on its website explaining exactly how the payment works, who qualifies, and when it is paid. Given the ongoing pressures on household energy costs across Britain, this payment can be meaningful for older people who may otherwise struggle to heat their homes adequately during winter. It is also worth addressing something that comes up frequently in discussions about pension changes: the distinction between what the DWP administers and what is handled through other agencies or local bodies. The DWP is responsible for state pension payments, pension credit, and most national benefits. However, housing benefit for pensioners is in a period of transition, with plans to migrate eligible recipients onto the pension credit system over time. If you are currently receiving housing benefit and you have received any communication from the DWP or your local authority about your status, it is essential that you respond to that communication promptly. Missing a deadline in this transition process could result in a gap in your support. For those who are approaching state pension age in the coming months, there are some practical steps worth knowing about. The DWP will typically send you a letter or notification approximately 2 to 3 months before your state pension age, but it is your responsibility to make the claim. The pension does not start automatically. If you do not claim it, it will not be paid. You can defer your state pension if you wish to continue working, and deferring it does increase the amount you will eventually receive. However, the calculations around deferral can be complex, and whether it makes financial sense depends on your individual circumstances, including your health, your other income sources, and how long you realistically expect to be drawing the pension. One area that continues to cause confusion is the difference between the new state pension and the older basic state pension, and whether people with protected payment entitlements, those who built up pension rights under the old system before April 2016, are receiving what they are owed. The government has conducted reviews in recent years to identify and correct underpayments, particularly affecting married women, widows, and people over 80 who were underpaid due to administrative errors. If you believe you may have been underpaid, or if you are the family member of someone who was, there is a process through the DWP to raise this and have your case reviewed. This is not a trivial issue. The underpayments involved have in some cases amounted to thousands of pounds, and the government has committed to identifying and correcting them. Throughout all of these changes, the recurring theme is the importance of staying informed and taking action. The pension system is designed to support you, but it requires engagement. It requires checking your records, making claims, responding to correspondence, and occasionally asking questions. The resources to help you do this are there, through Gov.uk, through the DWP helplines, through Age UK and Citizens Advice, which both offer free and reliable guidance to older people navigating these systems. As we move through the rest of 2026, further updates are expected, including potential adjustments to the pension age timetable and ongoing reviews of how pensioner benefits interact with the broader welfare system. These are not distant concerns. They are live discussions that will affect real people in the coming months and years. Staying on top of them is not about being anxious. It is about being prepared. If this video has helped you understand even one aspect of how the pension system works and what is changing right now, then it has done its job. We work hard to bring you accurate, clearly explained, and timely information about the updates that matter most to pensioners across Britain. There is a lot of noise out there, and our goal is to cut through it and give you clarity. So if you want to be the first to know when new pension updates are confirmed, when payment dates change, when benefit rules are adjusted, or when new guidance is issued by the DWP or the government, please subscribe to this channel and make sure your notifications are turned on. Every week, we bring you the latest fully verified information so you never miss an update that could affect your income or your entitlements. Subscribe now and let us keep you informed together.